I make my living trading on the stock market. I'm really fortunate. I don't have to have a real job. I make enough just from trading in small companies to have a really good lifestyle. Don't get me wrong, I'm not some sort of fantastic hedge fund millionaire, and I'm not a tech bro billionaire, but I do make a really good living. And in these videos, I'm going to try and show you exactly how I do it. Hey everyone, Steve here from Strategic Ways. We had a big win this month, Burner Technologies. I'm going to go through Burner in a moment, but Burner is an example of how I think about the market, how I find these little companies, how I choose to invest in them, and how I make money out of it. I'm going to go through that later in the video because the model is the important thing. How you think about the market makes all the difference into what you decide to trade. But first of all, we're going to look at Burner. On the screen now, we've got the article I wrote about Burner Technologies on the Seeking Alpha website. I put everything on Seeking Alpha, mostly for transparency, so that you can see I did what I said I was going to do, and you can see when I said I was going to do it. You can see my wins and you can see my losses. For posterity, you know I'm not making any of this stuff up. So on August the 11th, I said buy Burner, strong buy recommendation, which means I'm buying it myself and putting it in my portfolio. I said to buy it, the price was $10.10. And since then, today's what, 7th of September, it's up 42%. Now that's a big win. That's a lot of money. Pays for my lifestyle. Of course, not every stock I invest in can make 40% plus in less than a month. But Burner's an example. And I want to go through how I found Burner. And it's about this model I'm talking about, how I view the marketplace, how I view price action and what's going on. It's the crucial understanding that made all the difference. It turned me from being a loser in the market to being a winner. And I want to tell you all about it. I just mentioned price action, so let's talk about price. I've got a chart on the screen, Bluebird. Now, if I showed this to your average third grader, they'd be able to tell me when I should buy this thing and when I should sell it. I should have bought it here, shouldn't I? Any time between, I don't know, what's that? Middle of October-ish. Yeah, middle of October till middle of November, end of November. That would be the perfect time to buy, and the perfect time to sell would be up here, sort of, June-ish, when the price was in the $57. Of course, we don't know what's going to happen next, so that might not in the end turn out to be the best price to sell, but we definitely know when the best price to buy was. Um, and it's all, I keep talking about my model. It's all about the model, and people have different views about what's driving the stock market. Some people have got this weird notion about bulls and bears fighting over this stock, pulling it in each direction. It's just ludicrous when you think about it. If you're bearish about a stock, you don't do anything. You just leave it and go off and find another one. Other people have got these ridiculous ideas that they kind of draw an imaginary line on the chart and call it a line of resistance, and imagine that because I've drawn that line on it, it's real and the stock's going to keep bouncing off that line. It's just pointless. Other people think it's kind of decided by the gods with Fibonacci numbers. It's just absolutely ludicrous. They miss the fact that price is a reflection of what's going on. It's not the decider of what's going on. I'm going to talk now about my model in some greater detail, and come back at the end of this video and have a look what I did, how I applied it to Bluebird. On the screen now, we've got three charts. It's Bluebird and two of its competitors, and from around the same time. Um, there is no technical in the world, there's no bot in the world that wouldn't tell you to buy these three things at this time. All three of them are putting in a low. Lows here, technicals would say buy. Low here, technicals say buy. Lows here, technicals would say buy. But it's absolutely rubbish. Let's have a look what happened. Now we can see those three companies: Bluebird, the electric school bus company in the US, Line Electric, competing in the same market with some really nice electric buses, and Green Power Motor, similarly great electric buses. But look at the difference in the year-long chart. Bluebird, as we've already seen, up massively, but the other two absolute collapses. If you'd have bought into those markets, you would have lost a load of money. And now that's why people are selling their signals for $20 a month, or they're selling their bots for $50 a shot. If they really had a technical solution, they'd be building huge data centers and getting their technical solution running on thousands of GPUs and raking in money like there's no tomorrow. But they're not. They're selling signals for $20 a shot. It's a complete fallacy. If you try to buy with technicals, you will lose your money. Now, I didn't make this up. It's like all things. We stand on the shoulders of giants, don't we? Other people invent this stuff and we just imply it. And the two giants I'm talking about are R.N. Elliott and Robert Prechter. Elliott was a very successful trader in the US in the 1920s and 30s, and he came up with his wave theory. And he came up with it because as he was buying stocks, he noticed a particular pattern, a kind of way they went up, and he saw this repeating time after time after time. And he wrote about it in one of his newsletters. He was an accountant, so he was he was into the money side of businesses, but when he saw success, it came with a wave. Then in the 1970s and 80s, Robert Prechter, who wrote the defining book about wave theory, he tried to understand what was driving that motion. And he built a model of the market, a socio-economic model of the market that viewed the stock market as a game with thousands of players who don't have any information. Nobody knows everything that's going on. Nobody knows what everybody knows, but we still play that game. And he calls it a game because it's effectively betting, isn't it? We buy a stock, put in money on the hope it's going to go up and make some money out of it. So it's a game. Now, Robert Prechter identified three types of players. He came up with smart money, big money, and dumb money. Now, we can't be big money because we're not rich enough, and we certainly don't want to be dumb money because they lose money all of the time. So in this model, we need to be smart money. I mean, I don't consider myself a particularly smart guy, but I've learned to behave in the way that smart money does, according to Robert Prechter and R.N. Elliott. I'm going to go over that now in a little detail, with drawing a few charts and things to show how this model works and how we can interpret it to help us make great decisions going forward. I'm going to try and imagine that we've got some kind of random made up stock and its price is just waving along, going particularly nowhere. Perhaps it's going down a bit, but there's no particular pattern to it. It's just kind of going nowhere. Robert Prechter says there are some really smart guys in the stock market. These guys, some of them might be accountants who can look into the balance sheet and they can see some hidden value that nobody else has spotted. Other ones might be experts in competitive strategy and they can see how this company has developed a competitive advantage relative to its competitions. Other guys might be technical experts. They might really understand the tech that this company is developing and see how it's better than that developed by its competition. Now, for whatever reason, these guys recognize that this company is undervalued because its sales are going to increase. All of those advantages, sales and revenue, is going to go up. And so they decide to buy. So let's get a little smart money arrives. Let's get that down so we can see that smart is in. Smart is in. Now, once we have buyers in a marketplace, the price starts to go up. That's what decides whether the price is going up or down. It's buyers and sellers. It's got nothing to do with what's happened in the price before. If we've got more buyers than we have sellers, price goes up. If we've got more sellers than we have buyers, price goes down. And technicals are just a kind of representation of what's driving a market. After a little while, the smart money's in. It's already bought its stock. They're not, smart money's not got a lot of money, but it finishes buying. And when it stops buying, the stock market starts to drift again and maybe goes down a little bit, kind of like this. At some point later, big money arrives. Now, big money is equally as clever and smart as smart money. But big money, we're talking about institutions, we're talking about big hedge funds, we're talking about pension funds and investment houses, and it takes them longer to make a decision. They're investing other people's money, so they've got to go through a large due diligence process. They see exactly the same thing smart money saw, and they come to the same conclusions. It just takes them longer because they're bigger companies. Now, once big money decides to buy, it means that we've got more force behind this upward trend. There's more people buying. They're buying in bigger amounts, and so we see price goes up further and it goes up faster than it did when smart money arrived. Eventually, of course, big money, the initial wave of big money, they've got their money in and they've made their decision. And when we get up here, a couple of things start to happen. One thing is that smart money decides, this is about correctly valued now. They're looking at this saying, I've made myself 150%, I've made myself 200%, I've made a ton of money. So smart money decides to take its profit. So smart money goes out. Maybe it buys itself some new furniture or does a holiday, or buys some wine for his wife. When I first started this, that's what I used to do. After a big win, I'd take my wife out for dinner. It's important to use this money for something enjoyable. Now, the other thing that happens, I said there was two things. The other thing that happens is because it's up 200%, it's all over the media. Every pseudo analyst is telling you how they knew to buy it, at the very beginning, even though they're just making it up, how they knew this was going to happen, but they all tell you you've got to get in now. It's going up. You've got to, you've got to get in. Every newspaper's covering it. It's on CNN. Every Joe blogs on Facebook are covering it. But because smart money's out, we've got some sellers and the price starts to go down. But the general retail buyers are listening to all this stuff on Facebook, and they get fear of missing out. They're worried that if they don't get in now, they're going to lose money, and everybody is telling them that's the case. And so they start to buy. Procter did call these people dumb money. Retail investors. I was dumb money for a long time and lost a lot of money being dumb money. Don't do it anymore, thankfully, but I did for a long time. I learned the hard way not to be dumb. And what happens when dumb money starts to buy, it starts to go up a little bit. It starts to make, because we've got buyers in the market. And the fact that it's going up a little bit, that attracts loads more retail investors. They start to go, they go a little bit crazy, really. It just takes off on TikTok or wherever. It just takes off and people buying more and more and more. The problem is, as was the case when we were buying, big money sees exactly the same things as smart money does. Smart money realized the thing was, more or less appropriately valued at this point and decided to take some profit. Well, big money sees the same thing. A lot of big money makes the same decisions and decides to take profit. Of course, big money's got some investors and traders working for it, and by taking this profit they guarantee themselves a really nice Christmas bonus, so they're happy to get out and book their 200%. Now, big money's getting out, so it has a bigger impact than when smart money goes down, and it falls faster. Now, of course, dumb money takes a hit here. They got in, prices collapsing, they're down 30%, 20%, whatever it is, and they get out. Effectively, it's almost like a tax. Dumb money transfers its money to smart money and big money. The poor giving money to the rich. That's kind of the way it always has been since, I don't know, the 14th century or something, maybe even before that. So now we've got our model, we've got our understanding of the marketplace. It's a game with three types of players: smart money, big money, dumb money. And we want to be smart money. We want to buy the way smart money does. And smart money buys because a company is undervalued. So we're going to have to look at a way of valuing companies. It's all to do with cash and profit. Their ability to generate cash dictates how much a business is worth and whether smart money is going to buy it or not. It's going to go back now. Let's have a look at how we've done in the past and see how we've applied this before future videos tell us a bit more of the detail. So back to that bluebird chart we saw at the beginning of the of this little video, and remember we talked about when would a third grader tell us to buy. So let's go back and check those dates out again. So we're third graders, we're talking about buying somewhere, I guess, between here, the middle of October, and kind of the end of November. That's when we'd want to buy this stock to time it perfectly. So let's have a look at what I did. This is my article that I wrote about Bluebird. When did it publish? October the 24th, exactly in the middle of the perfect time to buy. And how did I rate it? A strong buy, meaning I'm going to buy it and you should buy it. At the time the price was $18 and it's up 152%. That's a huge gain, an enormous gain. Now you can also see these little green dots. This is the one where I first bought it, but I said to buy again at this point. That's the second time I saw smart money getting in, and that's done really well. So I didn't buy a second time. I'm just reiterating the rating. I was making the decision, do I come out or do I not? But I stayed in and I made a good amount of money. Now that's what we need to do. We need to understand how smart money behaves and follow what they do. We can't be smart, but we can behave in smart money ways. So now we've got our model. We understand what we're trying to do, and in the next video I'm going to show you exactly how I found Bluebird and its three competitors, and how I decided to invest in Bluebird and not the other two. I hope you enjoyed that video. I hope you've now got this understanding of what we're trying to achieve. I hope you've seen how it's made us a good amount of money, and I'm going to teach you exactly how to apply this yourself in your trading to make some more money. If you enjoyed the video, please hit the like button. But if you want to see the next one that shows exactly how we found Bluebird and exactly what we're going to find next, then hit the subscribe button and watch the next video and the ones that follow. Thanks for listening. Really hope you enjoyed it.